Good afternoon. Since the January meeting of the Monetary Policy Committee, the bank's forecast for inflation has continued to moderate in line with monthly inflation data and recent lower oil prices. Globally, a once healthy economic growth outlook has been revised down sharply due to the outbreak and spread of COVID-19. This coronavirus will negatively affect global and domestic economic growth through the first half of 2020 and potentially longer, depending on steps taken to limit its spread. The COVID-19 outbreak will have a major health and social impact, and forecasting global and domestic activity presents significant uncertainty. The Chinese economy, where the virus originated, is expected to contract by 1% in the first half of 2020. Economic activity is likely to also contract in the United States and Europe as governments there take actions to contain the spread of the virus. In financial markets, the sustained global bull market in equities and corporate bonds also ended dramatically last week, with extensive and deep repricing. Prices for emerging market sovereign debt and other risky assets also fell sharply. This will have repercussions for household wealth and income, impacting further on global economic growth. In response to all these developments, the United States Federal Reserve, alongside other central banks, took various steps to provide further monetary accommodation. Additional steps have also been taken to provide liquidity and ensure the smooth functioning of markets. Some governments have taken fiscal measures to mitigate the economic effects of the virus. In light of these considerations, we have marked down global growth for 2020 to 1.1% before it rises to around 2.8% in 2021. While a deeper or longer global and domestic contraction is not in our baseline, the committee did consider a scenario featuring that possibility. Prices for some commodities have fallen as a result of weaker demand globally, with copper and oil being particularly hard hit. The spot price for Brent crude oil is currently around $30 per barrel, but is expected to bounce back to higher levels. For our forecast, the Brent crude oil price is expected to average around $40 per barrel in 2020 and $44 per barrel in 2021, well below previous assumptions. The domestic economic outlook remains fragile. At this point, COVID-19 is likely to result in weaker demand for exports and domestic goods and services, but its impact on the economy could be partly offset by lower oil prices. We also expect disruptions to supply chains and to normal business operations. The bank now expects the economy to contract by 0.2% in 2020. GDP growth is expected to rise to 1% in 2021 and to 1.6% in 2022. Apart from the COVID-19 global pandemic, electricity supply constraints and other sources of uncertainty are expected to keep economic activity muted. Public sector investment has declined and job creation has slowed. Business and household confidence have weakened further. Government and household consumption and private investment, however, continue to grow, albeit modestly. While export growth is expected to decelerate further in the near term, prices remain high for some export commodities and could be supported by an early resumption in China's economic activity. The technical recession of the latter half of 2019 contributed to a lower economic growth forecast. In addition, COVID-19 and existing constraints such as load shedding imply significant downside risk to the forecast. With persistently low inflation and the coronavirus now hitting economic activity, monetary policy in major advanced economies and China will likely remain accommodative over the medium term. Easy global financing conditions have previously supported the value of the local currency, but financial volatility and a sharp rise in perceived risk has caused the rand to depreciate by 17.2% against the US dollar since January. The implied starting point for the rand forecast is 15 rands 30 to the US dollar compared with 14 rands 90 at the time of the previous meeting. The forecast shows the currency strengthening over time, recovering towards its longer run equilibrium level. The bank's headline consumer price inflation forecast averages 3.8% for 2020, 4.6% for 2021, and 4.4% in 2022. The forecast for core inflation is lower at 3.9% in 2020, 4.3% in 2021, and 4.4% in 2022. With the downward revision to the forecast, the overall risks to the inflation outlook at this time appear to be balanced. Electricity pricing remains an immediate concern, and there is likely to be higher volatility in prices of other goods and services as a result of sharp changes in demand and supply. Risks to inflation from recent currency depreciation are expected to be muted as pass-through is slow and could be offset by a wider output gap. Food price inflation is expected to remain low, in part due to better weather conditions. Expectations of future inflation have moderated further on the back of lower services prices, modest food price inflation, and slower growing nominal wages. Across the different surveys we look at, inflation expectations currently average 4.4% in 2020, 4.6% for 2021, and 4.7% in 2025. Market-based expectations have also moderated, with 5-year break-even rates currently at about 3.9%. Heightened risk sentiment in global markets has amplified domestic and fiscal risks. This has pushed South Africa's sovereign bond yields sharply higher and weakened the domestic currency, increasing risks to monetary policy. The steep drop in global real interest rates implemented by advanced economies in recent days has partly offset those risks. Despite the general rise in risk, the significantly lower forecast for headline inflation has created space for monetary policy to respond to the rapid deterioration in economic conditions. Barring severe and persistent currency and oil shocks, inflation is expected to be well contained, remaining below the midpoint of the target in 2020 and close to the midpoint in 2021. Against this backdrop, the MPC decided to cut the repo rate by 100 basis points. This takes the repo rate to 5.25% per annum with effect from 20 March 2020. The decision was unanimous. The implied path of policy rates over the forecast period generated by the quarterly projection model indicated 3 repo rate cuts of 25 basis points each in the second and fourth quarter of 2020, as well as in the third quarter of 2021. Monetary policy can ease financial conditions and improve the resilience of households and firms to the short-term economic implications of COVID-19. Our decision and its magnitude seeks to do this in the near term. Monetary policy, however, cannot on its own improve the potential growth rate of the economy or reduce fiscal risks. Current economic conditions underscore the importance of implementing prudent macroeconomic policies and structural reforms that lower costs generally and increase investment opportunities, potential growth, and job creation. Global economic and financial conditions are expected to remain highly volatile for the foreseeable future. The committee will continue to assess risks to inflation, including from weaker economic growth and those arising from wage, price pressures, and currency depreciation. As usual, the repo rate projection from the QPM remains a broad policy guide which can change from meeting to meeting in response to changing data and risks. That concludes our statement. The press conference today is virtual because the journalists couldn't be here. As you might appreciate, we have got a national disaster declared, and so we are minimizing the number of people in these rooms. And at this stage, I will turn and take the questions. They will be coming online, and Zianda will be assisting me there. If you could prioritize the media, that is what this is, a media conference.
Governor, 2 questions from Lindley from Business Day. What meetings has the SARB had with major banks or financial sector regarding risks in the financial sector sparked by the crisis, and how concerned is the PA regarding the health of the financial system? The second question, how concerned is the bank and the PA about the risk of either government or major SOEs, e.g. Eskom, and their ability to raise debt under current circumstances?
Okay,
I have a third question, but it's from an analyst, so we'll wait.
No? Okay, there isn't another one from the...
No, that's all from the media for now.
We are in constant conversation with banks. In the current environment with the national disaster, the meetings are not physical. We are talking on the phone. We would talk over video conferencing. It's a constant thing. We do that all the time. And it is so because we have got responsibility to oversee the financial system, firstly, broadly. It is also done because we always have regulatory or supervisory issues with each one of the institutions that we supervise. The financial system in South Africa is healthy. It is well capitalized with ample liquidity and meets all the requirements in terms of Basel III, which had been incorporated into our domestic regulations. In the previous crisis, it was precisely because our banking system was strong and well capitalized that allowed us to weather the crisis. Since the introduction of Basel III, the capital and liquidity standards have been strengthened, and the South African banking system meets those standards and is in an even much stronger position than it was in 2008. The current situation is, of course, a trying one and will constantly test the resilience of the financial system. We have not seen any stresses in the financial system at the moment. The third question had to do with how concerned are we about the ability of ESCOM or the Treasury to raise funding. Well, I think that question must be directed to the ESCOM and the Treasury as to whether they are concerned about their ability to raise funding.
More questions, Governor, from Bloomberg. One, it's a couple from Bloomberg. One, under what circumstances would the SARB consider using other non-monetary policy tools to provide relief, and what kind of tools would you consider? Second question, what specific steps does the South African government need to take to rescue the economy? How can government stimulate economic growth in the face of the coronavirus shutting down trade, travel, and other activity? Another question, at what time of GFC SARB held monthly MPC meetings? Is that back on the table? Fourth question, the Banking Association has said it is urgently consulting banking regulators and competition authorities to determine how best it can respond to the social and economic impact of the virus. What measures are being considered? Is debt relief or payment holidays on the cards? Will banks have to start proactively restructuring loans?
Okay.
Business Day.
No, that is a handful. Can we deal with that so that I deal with this round and then I can start giving the difficult questions to my colleagues?
Perfect.
What other non-monetary tools are we consenting? We have stated we have got monetary policy space and we have used it. So there isn't a need for us to go and consider other tools. The other tools that people end up deploying, they deploy because they are at the zero lower bound. And because they are at zero lower bound, they are having to add to an array of tools. We do have tools in our toolkit that had always been used, whether it is the reserve requirements and the operations that we do to stabilize domestic money markets. Those tools are there for us to use as appropriate, but there is no need for us to be using unconventional tools at the moment. Our conventional tools are just working just fine. What should the government do to rescue the economy? That is a question best directed to government. What should government do to stimulate the economy? That is the question best directed to government. What we could say is that from the monetary authorities' perspective, we have taken the steps within our mandate to mitigate against the risks that the economy is exposed to. And as we had said, is that it would actually strengthen the resilience of businesses and households. Naidu is going to deal with the BASA thing and the competitions authority. During the GFC, we had, the SAP ended up with monthly meetings. That was for a very limited period of time. And it just so happened that the global financial crisis set in like a week or two after an MPC had ended and the SAP switched to that. At the moment, we do not think that there is any need for us to meet on a monthly basis. The situation is fluid. We continue to assess the situation. Should we be in a position where we feel that we have got to do something urgently, there is nothing that stops us from convening an urgent meeting. But as things stand, there was nothing that necessitated such, and there is nothing that necessitated that we switch to monthly meetings. Naidu?
Thanks, Chair. Chair, I think you've actually answered most of that question. We are in daily contact with the banks and with BASA. We're in daily contact under normal circumstances, but certainly at the moment we're monitoring the banks quite closely. We are being informed of both operational issues in the banking system, such as staff who may get sick and branch closures, but we're also being informed about whether there are any stresses in the system. We feel that the present mechanisms that we have, forums that we have, are adequate to deal with any of those stresses. There are certain decisions that businesses and banks would take off their own accord. We would welcome those. We're monitoring those, and they certainly will discuss those with us. So in that sense, I don't think that there's anything extraordinary, precisely because we do have the mechanisms to deal with such a situation in the normal course of events.
The thing about the competition, Basa talking to the competition authorities.
Chair, I don't quite know how to respond to that. I mean, it's up to the competition authority, or in fact the minister responsible for the competition authority, to amend or gazette any changes to regulations. We talk to the banks generally individually, but sometimes collectively about these issues. If there is a collective effort from the banks, I think that they are the correct forums and channels to channel that through.
Yes, now.
Okay. Business Times, Hilary Joffe, you've sort of responded to this question, Governor. Is the Reserve Bank planning to do anything to enable the commercial banks to provide assistance to customers in distress? Will you lighten the regulatory burden for banks to enable them to cope with higher rates of default? Business Day, Lucanio. With much of the economy in lockdown, how effective will interest rates be in supporting activity? Could the bank have announced more unconventional measures such as its peers in the US and Europe? Then Reuters, Alex Winning. Did the MPC consider risks arising from increased government borrowing, crowding out borrowing by private sector issuers? How large a move in the rand or sovereign bond yields would have the SARB considered a risk to financial stability, where it would consider intervening in the forex market?
Can you repeat that question? It says moves in the bond market, and then you must intervene in the forex market. You intervene in the market where there is a problem.
So it's Alex Winning. Did the MPC consider risks arising from increased government borrowing, crowding out borrowing by private sector issuers? Mm-hmm. How large a move in the rand or sovereign bond yields would the SARB consider a risk to financial stability, where it would consider intervening in the forex market?
Okay. Is that it?
That's it from the media for now.
Okay. Would we lighten regulation like the others have done? I think that the reference here would be where countries have got buffers. So one of the instruments in the macroprudential toolkit is the counter-cyclical capital buffer. It is an add-on requirement on banks to counter the financial cycle. In South Africa at the moment, the counter-cyclical capital buffer is 0. If we had it, it could have been considered that you can remove it. Well, we do not have it, so there is nothing to do with the counter-cyclical capital buffer. Would you enlighten regulations? Well, regulations get enlightened all the time depending on the circumstances. At the moment, as I had said, the banks are adequately capitalized and they are meeting all the regulatory requirements, and there is no pressure for us to enlighten regulation, and so it is not something that had crossed our mind. Lucanio, how effective would monetary policy be? Well, we think that we have the step that we have taken and the magnitude that we have taken should actually have an impact. Unlike our peers in the advanced economies where interest rates are almost 0, we do not have that problem, and that is why we could make the move. But we could also make the move for the very simple reason that we have been able to build the space over time. This is not the first crisis that we are facing. There was a crisis in 1998. There was a crisis in 2001, followed by a banking crisis in 2002. There was the global financial crisis. In 1998, when the crisis set in, the Reserve Bank found itself in a bind. Inflation was going up at the same time as the crisis, and interest rates had to go up. So became pro-cyclical. But there was also the question of the credibility of the monetary policy framework at the time. When the 2001 crisis hit us, which had its origins in Argentina, the inflation targeting framework was in its infancy, and it was actually tested. Inflation did breach the target and was brought back within the target. When the 2008 crisis hit us, inflation was within the target, and we had 8 years of experience in terms of implementing the inflation targeting framework. We had the fiscal buffers to respond to the crisis, and so both fiscal and monetary policy could provide stimulus to the economy. This crisis finds us better prepared from a monetary policy stance, for we have not just brought inflation down to the midpoint of the inflation targeting range, but inflation expectations are now anchored closer to that midpoint of our inflation targeting range. And then that tells us that we have that room, and that is what we did. We utilized that room. Risks if the risks, or what would the risks to the rand and bond yields, at what point would we intervene? I don't see the rise in bond yields or the depreciation of the currency to be leading to financial stability risks. A rise in bond yields, yes, will make the banks to market their portfolio, and this time it is also impacted by the fact that there is the liquidity coverage ratio where they end up having to hold high quality liquid assets, and so they have to mark those to market. With respect to the currency, again, we do not see the currency posing a financial stability risk. Why? Part of the big driver is that the South African banks, as per the prudential regulations, can only hold open positions in foreign currency up to a certain percentage of their capital and reserves. They are all within that. And so there isn't an issue of financial stability risk to talk about here. So we wouldn't be intervening in the markets because we are worried about the financial stability risks. In any case, if you are worried about financial stability risks, you deploy your macroprudential tools. You don't go and play poker in the foreign exchange market. There was a question about government which I didn't understand.
From Hillary?
No, from Reuters. What is it? The first one from
Whether government borrowing, whether we're concerned that government borrowing is crowding out private
Yes.
borrowing in the market.
Yes.
Well, that is not for us to make. There is no doubt that when government reduces its borrowing from the market, it opened the space for the private sector. At the moment, I can't say that we are seeing that crowding out. However, if there is concern that government would be crowding out the private sector, if ever there was a case for prudent fiscal policy, that is it.
Two more questions from the media, and then we can do the analysts, Governor. Ed Stoddard from Business Maverick. When were rates last this low? Business Times, Hillary. Do you foresee any need to provide liquidity support to markets, and would the bank be willing to do so if needed?
Monetary policy is about liquidity management. If we feel that the liquidity is drying in the market, we add liquidity. And if we feel that there is too much liquidity that might lead to inflation, we withdraw the liquidity. That is what monetary policy operations are about. And if we feel that there are potentially parts of the market that could be dysfunctional and might need central bank liquidity, it is part of our mandate. We would not hesitate to do that. We monitor that not on a daily basis, on a continuous basis. And we have got people who are watching this throughout the day. And if we pick up that there is a need to inject liquidity, we will not hesitate to inject the liquidity. When we raised last this low, well, they were once lower. They were once at 5%. And that was in 2013. So we are within 25 basis points of where rates were previously the lowest.
Last question from the media, Governor. Prinesha from Bloomberg. Please clarify, QPM indicates 3 cuts of 25 basis points each in the second and fourth quarter of 2020, as well as in the third quarter of 2021. Is this on top of today's cut?
No, it is not on top of today's cut. We have brought all of those cuts forward and added another one.
Okay. Analyst Morgan Stanley Andrea Messier from Morgan Stanley. What does the central bank plan to do about the extreme moves in the South African government bond market? Shouldn't the central bank be exploring options with National Treasury on an urgent basis?
Another analyst?
Yes. Razia Khan, Standard Charters. Should projections change, is there appetite to cut further? Andrea from Morgan Stanley. Governor, shouldn't you be moving to monthly MPC meetings to lower the risk of emergency meetings and remain nimble in this fluid environment? PSG. Francia Kaus from PSG. Why has the bank not announced broader financial measures to deal with the crisis, e.g., dealing with market stresses? Nazmira, 91. Is the SAB concerned by the liquidity problem that has developed in government bond markets? Is the SAB considering bordering access to the weekly repo auction? Dutch Bank, Danelli Messier. What are the risks that the CPI actually undershoots the 3 inflation floor? How would you respond in light of such a scenario?
Pause.
Last one. Oh.
Chris Lowald, how will you respond if inflation breaches the inflation floor? Rashad, if projections change, will you cut? Fundi, liquidity in the bond market and market stresses.
Thanks. So the question is there a risk of undershooting the floor? Yes, there is always a risk of that when there's so much volatility in the markets. The MPC discussed at length risks arising from more currency depreciation than we've seen up to now, as well as considerably lower GDP growth rates. And those tend to be offsetting risks on the inflation outcome. If it undershoots, we are confident that we've got more interest rate room to maneuver to deal with that. But I would say that we have factored in quite a lot of downside risk to the inflation forecast at the moment. Oil prices are playing quite a big role in the way in which headline CPI bounces back up into 2021. Our oil price forecast assumption that we've taken is much lower than previously. It is slightly above the current spot rate in the oil market, which is about $25, $26. But it's moved far, far lower than historical averages for the oil price has been. So we've tried to factor in quite a bit of that risk that the CPI could come out lower. But it's always a possibility, and we've got monetary policy space to deal with that should we need it.
Thank you very much, Governor. Well, I guess we should be waiting for the next meeting, but just to say that one of the important points we'd like to make is that we believe that the 100 basis points cut does not derail our long-term objective of keeping inflation around the midpoint. It's natural to say that if there is evidence that inflation is sustainably below the midpoint, we'll have to look at circumstances and assess our monetary stance if we get there. Likewise, the reverse may also be true. Thank you.
Fundi?
Thank you. So with regards to liquidity in government bond markets and market stresses, we continue to monitor what is going on in broader financial markets, and ensuring that the healthy functioning of financial markets is a key function that we undertake as the South African Reserve Bank. The key issue to monitor is to understand the elements that are causing stress in financial markets. With regards to the existing and evolving situation, yes, we are monitoring what is happening in government bond markets. And as the Governor highlighted earlier, and also Deputy Governor Naidu highlighted, we have a number of mechanisms that we have in place as the South African Reserve Bank, where we do see signs of market stress that would allow us to respond. So our teams are actively monitoring the situation, and a decision would be taken then as required.
Naidu, you wanted to add something on an earlier question?
Thanks, Chair. Hilary Joffrey asked on whether the Reserve Bank will be helping banks to help customers. In general, in countries where there have been measures to support small businesses or first-time buyers, in general, those have been fiscally funded. So I think it's a question about what government can do collectively. At this stage, we are not proposing giving any additional resources to banks specifically for that. We have a range of instruments to support banks, cushion banks, deal with the regulatory consequences if there is rising impairments or falling profits. We're nowhere near there at this stage, but we've got a range of instruments to support banks in that regard.
We will continue to talk to the analysts during the course of tomorrow and next week. Are there any other questions from the media?
2 more, Governor, and 3 from analysts.
No, we'll deal with the media. The analysts, we can talk to them.
Okay. Okay. Please, we've asked, it's Bloomberg. Okay. Reuters, which sectors are most vulnerable to the current financial market conditions? What has been the impact of COVID-19 on SA's country risk premium? Does the deep rate cut not reduce the attractive yield? Bloomberg Pranisha, how did the impact of a potential downgrade by Moody's next week factor into the MPC decision? That's all.
Okay. Lowald, impact of COVID and the country risk premium, and then I'll deal with Moody's after that.
Yeah, I mean, the country risk premium has gone up quite a lot in recent days. Our forecast has a higher risk premium relative to the previous forecast in January, 3.2 versus 3.8. If you look at the risk premium today, it's considerably higher than that. But there are different things going on here. It is true that our country risk premium has gone up, but it's also true that central banks across advanced economies are cutting rates and providing liquidity to the market, and all else equal, that tends to lower the neutral real rate that we face as a country. So on balance, our neutral real rate hasn't moved much. When we compare the real rate relative to other countries, I don't think the divergence, the difference is moving too much with our cut, because many other central banks around the world are responding to the COVID virus in the same kind of way and cutting interest rates in response. So the real rate differential that we face relative to other borrowers in the market shouldn't change very much. Thanks.
Which sectors do you think will be impacted by the current financial conditions? Do you have an idea?
I don't have any idea. I mean, so sectors that are heavily borrowed will face different kinds of stresses. Access to credit may be a little bit more restricted given the volatility, but with the lower interest rate, of course, they are saving on some of that debt cost, and that will vary sector by sector and industry by industry.
Fundi?
I think it's useful to just reflect that because this is a health crisis, it's coming through in a different way, in that sectors across the economy are affected. And the measures that governments are putting in place are slowing down economic activity. So it will be a lot more widespread. So if the question is tourism going to be affected than other sectors? Well, it's difficult to predict. We have cut down on the number of visitors coming through to South Africa. That affects a number of services, including restaurants. If you have limited public activity, things like soccer events and other entertainment events, they're not happening. You're telling restaurants to close a lot earlier. So the impact will be a lot wider across sectors, but we're unable to tell you the magnitude. But if we are slowing down economic activity and you have social distancing, it is a lot more widespread compared to other instances where we've had a general slowdown.
So put simply, we are dealing with a health disaster. It's not a financial disaster. That it has spilled into the financial sector is another matter. And I think the response from the South African authorities has been absolutely the correct one. The first response came from the health authorities before you started to ask the economic agents to come to the party, and I think that is absolutely correct. Moody's, we don't know what they are going to say. It's you keep on asking us whether we are factoring in a potential downgrade by Moody's, and the answer is still the same. The effect that Moody's would have on this is all going to be a function of whether it is in the prices or not, and then that is it. You said 3 analysts, it must be 3 analysts, and those are the last questions.
Peter Montalto from Intellidex. Whose job is it, the MPC or a micro-prudential committee, to make decisions on supporting banks in providing forbearance to banks, in particular support SMMEs? Second question from Peter. What circumstances are needed to be seen to get a cut in the reserve rate requirement? Third question from Peter.
Oh, no, you said 3 analysts. Can we move to the other analysts?
Okay. Matrix fund managers comment. How relevant is the liquidity shortage in the monetary policy transmission mechanism in light of the tightening brought about by Basel III and Virus Credit Amendment Acts? There is seemingly a cash shortage in the domestic market. Should the SARB not increase the size of the repo auction or allow government to draw down its sterilization deposits instead of increasing domestic issuance, given the dysfunction in the government bond market at the moment? Last question from Nedbank. Isaac, is there any coordination with other CMA central banks to ensure that the rand peg is protected?
Okay, Mr. Regulator, supporting banks and whose decision it is. I thought this, you would know that. And Fundi, this thing of liquidity shortage keeps on coming up. I think we have answered it, but I think maybe they need your voice, not mine. Okay, let's start with you, Naidu.
Sure. Thanks for the questions, Chair. The Financial Sector Regulation Act sets out amongst others, two key responsibilities for the Reserve Bank. The first is a financial stability responsibility, which sits with the Reserve Bank and is largely attributable to the governor. In the second instance, the Financial Sector Regulation Act sets out roles and responsibilities for the Prudential Authority in the prudential supervision of banks, insurance companies, stock exchanges, etc. Depending on which tool or which instrument is used, it is either the governor in his capacity as governor of the South African Reserve Bank or the Prudential Authority that would take those decisions. I should stress that the Prudential Authority is as a CEO, but it is also managed by a board called the Prudential Committee, which is chaired by the governor of the central bank. So in general, the buck stops with the governor of the central bank.
Oh, Mr. CEO. Fundi.
So I think it's important to repeat that the SARB regularly monitors activity in financial markets. We assess whether there are signs of stress. And where there are signs of stress, the SARB does have a number of tools available at its disposal. And some of those tools are within the realm of normal monetary policy operations, and we will, as deemed appropriate, make use of those tools as a SARB. Some other instruments, of course, depending on the size of the challenges that are there in the market, if they start to look like they pose financial stability risk, we do have a Financial Stability Committee of the SARB. And in that regard, we have got a financial stability toolkit that provides a range of measures for the bank to utilize.
Thank you very much. Peter, what would it take to cut the reserve requirements? Well, it is a tool that we have. We have not felt that there was any need to use it. We still have the space, and the repo rate is working just fine. And there was no need to go and play around with the reserve requirement. Carmen, you had also raised the issue of sterilization deposits. Well, they belong to the Treasury. It's not our decision. They belong to the Treasury. However, you've got to understand that in calculating government debt, those sterilization deposits are deducted from the gross debt. So when they report net debt, it includes the sterilization deposits. Now, people had asked with coordination about fiscal and monetary policy. How the sterilization deposits arose was because the Reserve Bank was building reserves and the Treasury couldn't provide bonds. And because the Treasury couldn't provide bonds, the Treasury held deposits in the National Treasury sterilization deposits. So it goes without saying that if they go and draw those down, one, net debt goes up, and secondly is that they will then put money in the system, which the SARB will then have to go and mop out, because otherwise the monetary transmission mechanism doesn't work. And it is something that we have got a standing committee between the two institutions that coordinates and looks at what is the impact on monetary conditions and what is the impact on government borrowing activities that continue to monitor that. Coordination, Isaac, with the CMA countries to make sure that the rent peg is protected. South Africa doesn't have a rent peg. The CMA countries have a peg to the rent. That peg is governed by a treaty, and in terms of that treaty, the CMA countries must keep a certain level of reserves. Those reserves must, at the very least, match 1-for-1 their domestic currency that is in circulation. And through the mechanism, they are compensated for the rent that is in circulation in their countries. And it's a significant revenue earner for them. So it is in their interest to protect the peg, because failure to protect the peg and the peg collapses, they will also lose seigniorage that they are being compensated for by South Africa. Thank you very much. That concludes today's proceedings, and we'll see you again in May.